Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about housing inventory and how it's growing, mortgage rates, and purchase apps. Let's get to it. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah.
Great to have you on, especially because we are talking about a favorite topic of yours, which we cover every week in the Housing Market Tracker, and that is housing inventory.
Yes. Inventory, and also we get to talk about Neil Kashkari and rates again. And I was thinking about, this is 2024, right? We're going to have one crazy podcast at the end of this year to just go back and talk about this crazy 5-year period. For those of you who might not know, in the previous decade, when I started writing about housing economics in 2010, I always talked about, from now until 2020, we will have the weakest housing recovery ever. But years 2020 and 2024 are going to be much different. And here we are, we're almost, kind of to the halfway point. And that one's going to be a lot of fun. You're going to have to inject me with something so I won't go completely crazy. But that'll be very entertaining. But this week will be very entertaining as well.
I will not be injecting you with anything. I'm just saying that right now. You'll have to take some, avoid the coffee in the morning or something like that. But yeah, no, it's interesting because when you and I first started talking, the years 2020 to 2024 and the demographic patch and all the things with that were so important. And then, of course, we had the pandemic, so that just threw a wrench into the whole thing. But really looking forward to that discussion. I've asked you privately, I'm like, okay, now tell me what about this? And you won't say anything. It's not just on the podcast. You have been tight-lipped about this, even in private conversations, because you're like, nope, we're not talking about what happens in 2025 till we get closer.
This was supposed to be a 5-year unique period. Actually, I wasn't supposed to be writing anymore after 2024. I was supposed to be it. But because of how crazy it's been, some things are going to change for my kind of outlook and some things won't. But the fear as always is that this is a period in time where possibly because of inventory channels like what we're talking about today, home prices has the potential to kind of escalate out of control if all these bad things happen at once. But this year, speaking of 2024, the positive story for housing and why I'm even smiling more and more is that inventory is growing and we're creating the buffer that we need. That wasn't the case. Of course, we just got Case-Shiller Home Price Index and FHFA home prices are at all-time highs. So just imagine me going back all the way to 2021, dealing with the forbearance crash bros, and telling everyone that mortgage rates would be trending at 6 to 8% toward the second half of 2022, 2023, and 2024, with home sales having the biggest crash ever in 2022 and staying in the third calendar year of the lowest home sales ever. And home prices hit all-time highs. Not one person would believe me. I'd get tomatoes, cabbages, and carrots. By the way, you can throw them all you want. You'll never be able to hit me. And in that case, why, right? And it's just that inventory got to such a bad level, the whole unhealthy housing market into savagely unhealthy housing market, that we have to create a buffer. Because if rates fall down even just to 6%, the inventory channels look much different. You need higher rates with duration to create some kind of buffer from these record low levels. And we have, the all-time low is kind of around 240,000 in March of 2022. We're now heading up to, which I think we can crack over 700,000 this year for our Altos data. It's different than the NAR. NAR is at about 1.21. If we could get to 1.52 million and we could get 4 months of supply plus that, all these things to me are positive because I've always said the whole team higher rates thing in February 2021 was like, listen, we need higher rates to cool down the housing market. The problem back then is the unemployment rate was still at over 6%. Millions of people didn't get their jobs back. Nobody knew what was going on in COVID still, right? People were talking about forbearance crashes and nobody believed the recovery. For us, it's different. We wrote the COVID-19 recovery model on April 7th, 2020. We retired it December 9th, 2020. So we have a different kind of mindset. But here, imagine if rates had just stayed between 4.5 to 5.5, never got to, 7 to 8%. the inventory levels would be depressed. And the reason I say this is that if you look at other countries, Canada, Australia, their home prices escalated. Their home prices versus per capita income, all these things are so much higher over there. And they had this massive surge in home prices. We never had that here, right, in America. So the potential of having escalating home prices was in play. And now things are cooling down. Home price growth is cooling down. I know I'm trying to convince people that, the 6-7% year-over-year price gains you see in Case-Shiller, we have a very low comp. The growth rate is slowing down already and the comps are going to get harder. So you put those together, the growth rate of pricing is going to cool down for sure. You have to just give it time. Remember, our weekly data is months ahead of everyone else, right? They are too old, too slow. We are here and looking out forward.
I love it. Okay, well, let's get specific. So you had a target for this spring. You hoped to see inventory levels get between 11,000 and 16,000, the growth of that, 11,000 and 16,000 houses every week. Where did we land this last week?
11 and 17,000. Last year, batting a whopping 0. So when rates get above 7.25, we should have some weeks, the 11 to 17,000. Last year, nothing. We were close. We got up to like 9 or 10, but we never really got above there. And again, last year, new listings data was trending at the lowest levels ever recorded in history. And remember, supply is a function of demand in housing. But one thing that happened last year, and this is, going on CNBC kind of mid-year and toward the end of the year, trying to convince people new listings data has bottomed. And the reason I said that last year is that when mortgage rates got to 8%, new listings data didn't take another leg lower, right? It wasn't like what we saw after, when mortgage rates got above 6% in 2022. That means we're working off a bottom. So if we get more new listings, we'll get a little bit more sales. That's what we see in our pending contracts. Our weekly pending contracts are showing just a little bit of growth year over year. And that's all really it is in 2024. But the fact that this year, and remember, be careful of like putting weights on percentages, take nominal numbers and then divide that to the workforce, right, out there. It's growing, right? Active inventory is growing. The nominal number is growing. We're not back to 2019 levels. God knows we're nowhere close to 2007. But in this case, it creates a buffer because even when mortgage rates got down to 6% in 2022, right? Toward the end of 2022, rates fell down. And in 2023, we got down to 6%. What that did is that created enough forward-looking demand to keep inventory from really growing. And in that whole year, we didn't have really much growth. Mortgage rates had to get to 8% to allow the inventory channels to grow a little bit more. So I am just remarkably, unbelievably giddy that we're finally creating a buffer and then that we don't have to worry about home prices going up 15%. Because remember, this housing market is going to be here for a very long time, right? It's going to be here next 5 years, 10 years, 15 years. We're all going to be dead. The housing market is still here. You do not want constant escalating home prices like you see in Canada and Australia and all these other countries because the pool of buyers become less and less, right? Or you need lower and lower rates to keep it going. And here, third calendar year of the lowest home sales ever. It doesn't take much to move it. But now that home prices are cooling down, right? The growth rate's cooling down. Wages are keep increasing. Once rates fall, you could get a little bit of boost of demand like we saw before, and you don't have to worry about escalating home prices. And that was always key. That's why this year you had to see inventory growth. Now, I've only had 3 weeks where I've hit my target between 11 to 17,000. They've all hit the model. There was actually 4 weeks, but I don't count the holiday week rebound. And that's better than last year. The only thing that hasn't happened yet that I was 100% sure would is that new listings data would get to 80,000 this year. So far, we've kind of in the 72 to 73,000. And just remember, new listings data has been trending at the lowest levels ever recorded in history the last 4 years. In 2008 to 2012, that was running at 250 to 400,000 per week. Here it was between 30 to 90K. If you wanted to look at the peak levels of 2013 and 2019, you're looking at 95 to 110,000 seasonal peaks. 90,000 was kind of the peak of this last 4 years. We had that in 2022. So I'm like hoping for 95 to 110, but that's kind of that would be too good to be true. But at least 80K we could have. And that's lower than 2022 levels, but it's much better than what we saw last year. Last year was not a good year, right? We didn't get any inventory growth. New listings data didn't go. Home sales were trending very low and prices went up, just makes things less affordable. So it is a total 100% positive that this is happening. And we're kind of toward the seasonal peak of where mortgage purchase application data, I kind of waited between the second week of January and the first week of May. After May, total volumes tend to fall. But we're working from such low levels that it doesn't really take much to move the needle. So whenever rates do fall, we're in a better spot. Regardless of anything, we are in a better spot. We could handle it better now than we did, a few years ago or even early 2023.
Okay, so we're not at 80K. Where are we? What do new listings?
The last new listings data was 72,000. We're toward this. This is basically around the seasonal peak period. So I would give myself maybe 3 or 4 weeks to maybe get over 80. Again, we're going to get the Memorial Day weekend dive because last weekend, a lot of people just go on vacation. We'll get a rebound, and then we just have maybe 1 or 2 weeks, and then we see the seasonal decline out here. And so far, higher rates have not deterred the data line to retrace back to 2023 levels, which was the lowest. Again, another positive. Most sellers are buyers, right? So remember how the inventory channel works here. We create this model to keep it simple. Most sellers are buyers, 70 to 80%. Let's take that. You have a 20 to 30% left over. But if first-time home buyers come into the mix, they don't give you a house, right? So that mortgage demand takes the little inventory off of it, and then you can see this downtrend in inventory that started from really in 2014, after qualified mortgage came in, and we're just kind of stuck here pre-2019. And think about, this is year 5 now, right? And the NAR's data is not going to get to kind of the traditional 4-decade average, but we're growing. And see how hard it is. Look, we hit 3 years of the lowest home sales ever with rates between 6 to 8%, and all we got is this. But this is much better than what we had to deal with last year.
A huge positive, really. So, okay, let's switch. Let's talk about mortgage rates, which leads us to our friend, your friend, Fed
Neil
President Neil
Kashkari did it again. Yes, Neil, president of the Minneapolis Fed, always hawkish, right? Acknowledge that the labor market is not as tight as it was, but still tight. And now I'm kind of somewhat trolling him on Twitter. Oh my God, look, Neil, wages are going down. Congratulations, all Fed presidents stand up, right? So there are some people who just don't understand what he's talking about. But what do we always say? From 2022, we've stayed consistent. Not until the labor market breaks, right? And we've had constant Fed talk where they talk about now, jobless claims are so low. Okay, that's what we're really looking at. We can do this as long as the labor market stays resilient. Once it breaks, they will fold. But they're going to wait till the very last second. And then once jobless claims start to tick up and the bond market starts to fall down, and then they're going to go, oh my God, I can't believe I didn't see this coming. So I just want everyone to know, this is by choice. This is the COVID-19 housing policy. This is that we need to attack the labor market. We need to attack wage growth, right? Like President Waller said, wage growth is too high. You people are making too much money. Stop it. We have to attack it, right? So they've kind of really kind of kept in line out here. So the Fed is always a controversial topic. So you always have extreme people take different shots at them. But in this case, hopefully some of the behavior and the 10-year yield and everything starts to make sense.
So every day you update our mortgage rate center with where you think rates are going to go, what spreads are doing, where you think what bond the yields are doing, and where you think rates are going to go. One of the things you always talk about is the spreads. So I know we've had some crazy couple of days there. Can you explain what is going on there to the uninitiated? What are we talking about?
So right now, historically, mortgage rates should be 75 basis points to 1% lower. The spreads, normal spreads, going back to the early 1970s, the spreads is the difference between the 10-year yield and 30-year mortgage. When you have stress in the mortgage market or business risk and early payoff risk, all these things, the spreads get up higher to compensate investor appetite. So in this context, right, or the risk, the spreads this year are much better than last year. And for an example, today, mortgage rates, the 10-year yield's at 4.62. Last year, if you take the worst levels of the spread, we're 60 basis points higher, right? So we're kind of, 8% or near 8% mortgage rates today if we had last year's spread. So what happened is the Silicon Valley banking crisis made the spreads worse, right? So the marketplace had stress. Now, even in this week was very volatile. We had good spreads, and then the 10-year yield shot up. Even in a volatile weekly marketplace, the spreads are much better than last year. So like I always told you last year, Sarah, boy, man, just be grateful that it's not higher, right? Because where the 10-year yield is, mortgage rates should be higher. They finally got toward 8%. But here, everyone should be grateful that it's not near or at 8% today, because the spreads of last year could have taken us there. So that's a positive. And again, when the 10-year yield goes down, when the Fed finally does pivot and the bond market believes it, the spread's getting better and the 10-year yield coming together. That's that double whammy, right? That's that double whammy effect. And the labor market is always key on that. That's why we always write about the labor market and construction jobs and everything. But the fact that the spreads are getting better now, imagine when the 10-year yield falls and spreads get better, right? And that helps everyone, in the real estate industry. That's more business for everyone, but that also for consumers, right? For American consumers that want to buy a home, that double whammy effect makes things better for them. So the spreads is something that we never had to really talk about too much over the last 15 years up until 2022. So now people can see the difference. So again, the slow dance is what drives everything, right? Wherever the 10-year yield goes, the 30-year mortgage rate goes with it. But sometimes the dance partner is a little bit away. Sometimes it's very close. They're a little bit away right now, but a little bit closer this year than last year.
Good. And more good news. Inventory spreads. When does the next labor report come out?
Next week, not this Friday. And again, when we think about jobs data, always every single Thursday morning, jobless claims runs everything. If jobless claims start to tick up by itself, then what would happen is the 10-year yield would go lower before the Fed does anything. But, job openings is key, because the job openings data next week, that's what the Fed really tracks. The quits ratio is pre-COVID. The hires are pre-COVID. Wage growth is below 4%. That's something on BLS Jobs Friday. We want to keep an eye on all those things together, because kind of last time you could kind of see, even though the headline number missed, all the other internals of the labor market is no longer tight. It hasn't been tight for a while. I think now the Fed is somewhat a little bit more open to acknowledging that. But again, their whole premise is to keep financial conditions as tight as possible. So when the labor market breaks, they go, oh my God, we have our dual mandate. We have to be, more proactive now, right? So they're going to milk it. They're going to milk it as much as they can until that happens. And then our whole Federal Reserve discussion since 2022, the circle will be completed at that point. And then housing, in a sense, disproportionately gets benefited. And remember, for everyone out here, when the next job loss recession happens, we'll have more Americans working with better demographics than ever, working from very low levels of sales, right? It's a complete backdrop, different backdrop than any other time in recent history. So because you're so low in sales, any kind of push lower in rates helps demand. But if you're for lower for a longer period, then you have scale buyers coming in, right? Mortgage demand, purchase application data today, still 1990s levels. We're block partying out there, no doubt. We got Gangster Paradise. We got, Stop Chasing Waterfall. We got all the great music of the 1990s. Get DMX out there. Bring the Backstreet Boys or 98 Degrees and all we go back to memory lane. Real good basketball games back in the 1990s too. But in this case, man, boy, you got ways to go up, right? Doesn't take much. doesn't take much to move the needle. You're working from record lows, and we have so many people working. So when that happens, context will be key. We will work with the data to kind of give it some scale representation. But when you're working from very, very low depressed levels, it doesn't take much. So you can see purchase application data is not doing anything, right? We just basically stuck here in the 1990s. But when rates fall and every lower percent goes, the pool of buyers get bigger, right? Then you get more sellers that are buyers as well, right? That's another thing. So you get all aspects of all the buyer profile into play. Not there yet. Remember, COVID-19 housing policy, the Fed has never said anything positive for the housing market, except a few little tidbit lies. It's by choice, right? So 1970s, a lot of people forget, housing was booming in the 70s, right? Even with interest rates as high as it was. So the fear is, people buying homes, having sex, having kids, buying stuff for kids. Neil Kashkari will have a heart attack. Oh my God, Bostic would be like, oh my God, mortgage rates go lower. They might buy stuff for their children. And so all these things are just, Fed is so afraid of that.
So when you look at that, when you think about all the things we've talked about today, inventory rising at least somewhat, new listings rising, the potential for rates to moderate here at least, or maybe go down, what that looks like, if the jobless claims break at some point. Is there a point in this year in your mind where you're like, start looking for it in September, start looking for it in October, that the housing market might improve by then, right? We're always thinking like spring is the big thing, but it hasn't always been that way.
When we think about the labor market, we see it getting softer, right? The jobs data to me is still above what I thought it should be right about this time. So when the headline numbers start to come down and jobless claims start to rise, then the 10-year yield will go down. So the last kind of jobs report, we saw the 10-year yield go from 4.75 down to 4.34. If you start to get strings of softer than anticipated labor reports, the 10-year yield will do it itself. So we know that things are getting softer. They just haven't broken yet. When things break, the 10-year yield has shown us that twice now they will go ahead of the Fed, as they usually do. But you don't want to put a certain date or a month. You just want to follow the weekly data lines. And the 4-week moving average of jobless claims are still low. Job openings are still technically high, but the labor market is deteriorating in its softness, and we're seeing wage growth. So always remember, Jobs Friday, wage growth, the rule of thumb, 3% wage growth, because the Fed only believes in 1% productivity. Wage growth going toward that level now that we're under 4%. If we could get down to 3%, they themselves will start to be a little bit more dovish, because then that fits to their own model. Trust me, only the really geeky, nerdy people of this world knows that, because everyone else has a life. But the Feds really, really wants wage growth at 3%. They do not like it. Anything about you people making too much money makes their lives difficult. So wage growth coming down, positive. But so those things, we can see it getting softer. We're just not at the point of breaking yet. And when it breaks, man, the 10-year yield will go down so fast. There is no ifs, ands, or buts. We've seen 2 different times the bond market has tried to get ahead of the Fed. Both times have been rebuffed because the labor market wasn't breaking yet. Jobless claims was still too low. There's going to be a time when that does not. Unfortunately, that doesn't become the case. The labor market is broken. And then Neil Kashkari could go on TV and start grinning again.
Okay, well, you said you don't want to put a specific time period on it, but actually, I want you to put a specific time period on it. Logan Mohtashami, gaze into your crystal ball and tell me.
Dear, no, you can't.
Don't say honey dear to me. No, listen, gaze into your crystal ball and tell me, is fall going to be better than summer?
Well, technically, all falls have been better now. We talk about November as being a date. So is this the 3rd November that we'll see a 10-year yield fall? Now, again, we're at the higher upper end of this range. So the benefit is that the deterioration of a slowing marketplace running into a higher yield. Fall has been the time where the 10-year yield does go down, and rates have gotten better. We saw that in November 2022. We saw that in November 2023. Now, what's different than those last 2 years is that we're actually seeing some of the softness in the labor data to those that matter. But we still do not put dates, right? We do not do that. Think
Let-
about
no, no,
all
no.
these people,
Let's talk about it. You put April 7th of 2020.
because
You
that
were
was the
willing to go
beginning
on
of
the record.
that was the beginning of the recovery model. Why? And remember, why do we do that? Because the 10-year yield was above 62 basis points and the St. Louis Financial Stress Index was recovering. So I picked that date because of that. I could connect the dots to my model. Why did we retire it in December 9th? Well, the 10-year yield got to 1%. That was the last thing left. So those dates matter because an event happened to warrant that. Now, if jobless claims start to rise, right, we get to 323,000, then that warrants another thing. But you have to be careful of trying to look at the bond market, $1 trillion bond market. It's twice try to get ahead of the Federal Reserve on the economy weakening, right? It priced in 6 rate cuts. The Fed never even talked about 6 rate cuts, right? You don't want to get ahead of the data. Let the data get you there. Let the labor data hold your hand, Sarah. All of us, we're going to be like a family. We're going to hold our hands and we're going to walk it together one day at a time, right? That's my whole job every single day. What do you think I do on Instagram live stories? I literally go over all the economic data. We want to guide people to the pathway, right? The pathway is what matters.
All right, Logan. Okay, I will give you this one. I think it is the benefit that it's the right thing to do is not to put a thing on it. But if you're out there and you're a business person, you're trying to run your business, it's really hard without any idea of like when these things are going to happen. But I do appreciate you giving us those levels to look at. We can track it. And then, of course, every weekend you're tracking it.
It's speaking of that, I think in general, people have to somewhat be careful of who they listen to. One of the things I've seen in the last 18 months or even 2 years, a lot of people went into the recession's about to happen. The recession's about to happen. The 10-year yield's going to fall. Their Fed's going to do QE. They're going to do everything. Never happened. Why? Because you're projecting what you want the audience to hear, right? That's fine, but I argue that's not the way to do it. The way to do things is let the data do the talking first. Let it get a pathway. If jobless claims start to tick up noticeably, we're heading toward 3.320. Okay, we got something there. But if the bond market, which is trillions of dollars, can jump the gun and have this major crowded trade going up or down, right? You got to be careful, right? You can't use the human element can be wrong here, but the data as an aggregate, as a whole, as this enchilada, like I talk about, let it guide you, right? Where there are things that are, softening up to where it could be beneficial for rates, but we're quite not there yet. Because when it happens, boy, there's no ifs, ands, or buts, right? The verbiage of the Federal Reserve will change in that they will feel more, all of a sudden they'll get confidence about inflation. Well, it's not confidence about inflation. It's actually the dual mandate. So they'll do that. But we want to guide people so we can walk there. Walk the path, young Paraguay. Yes, grasshopper, not Paraguay grasshopper. Yeah. So all those who remember Kung Fu, remember those Kung Fu lessons that he taught.
I loved that. I loved that
Pain,
show. That's like the 70s right there. How old were you? You were like a very young
I wasn't
kid.
born the first half of the 1970s. So
You must have been watching it.
You'd remember it better than I would, Sarah.
Indeed, I do. Okay. All right, we'll stop there for today. Thank you so much, Logan. We'll talk to you again soon.
Pleasure.